This is the second of 3 parts for Lecture 1. For now, let us next discuss profits, which determine company value, because profit is a measure of company performance. The income statement reports the company profits in such amount generated normally for 1 year to be consistent with the current non-current classification of assets and liabilities on the balance sheet. The accounting equation is revenues minus expenses equals income. This income, also called earnings as you know, is what accumulates in retained earnings on the balance sheet. The assets on the balance sheet generate revenues and gains. For example, inventories are sold to generate sales revenues, an investment property is leased to generate rental revenues, or an old equipment is disposed for a gain. In generating revenues, the company incurs costs and expenses. For example, inventories sold are costs of sales revenues. Time use of investment property is depreciation expense. Uncollectible accounts from customers are provisions for bad debts. Or research and development for new products are expenses incurred. Furthermore, interest owed to creditors or taxes owed to the government are also expenses, while investments or early debt retirement sometimes lead to losses. You will notice that costs, expenses, and losses in effect consume the company's assets or create liabilities on the balance sheet. That is because, technically, expenses use assets or accrue liabilities. Revenues, on the other hand, if not received outright, create receivables, or if not earned on receipt, create unearned revenues. Both such items are reported on the balance sheet. When to recognize revenues and expenses is subject to accounting standards such as the IFRS or US GAAP. Nevertheless, revenues and expenses are recognized when earned or incurred, respectively, rather than received or paid, an accounting recognition method called accrual accounting. The diagram presents the income statement in a single-step format, as it produces one income measure called the net income, which people refer to as the bottom line, because it is the last item in the income statement if presented vertically. If intermediate profit measures are calculated, then the format is multi-step. Presented this way, we will see cost of sales directly matched with sales revenues to produce gross profit, or excluding other income and gains to produce operating income. Expenses may be presented by nature, such as depreciation, or by function, such as cost of sales. Similar to common-size balance sheet, we can present a common-size income statement by expressing each line item as a percentage of total revenues. A multi-step format reveals important ratios such as gross profit ratio and operating income ratio. We can also relate amounts between the balance sheet and income statement to reveal insightful information such as average time to collect from customers or to pay suppliers, how old the buildings and machinery are, or more importantly, earnings per share, which guides stock valuation using the price-earnings multiple among others. There are other items of income that are not presented on the income statement. For example, foreign exchange gains or actuarial pension losses are reported as other comprehensive income, which is accumulated outside of retained earnings. The statement of other comprehensive income is a separate statement, but when presented continuously with the income statement, such single statement is called the statement of comprehensive income.